Okay, we're still struggling to get two more people on, but I think we should start. And may I begin by saying welcome to those who have been able to get in. Just for your knowledge, we are going to record this as we have done before. So we will be sending you, if you would like, recordings of Wikus's talk. And most of you know Wikus, but for those who don't, he's the founder of Classic Private Wealth. He is a Cambridge qualified Master of Economics and has 30 odd years experience in this business. So we really value his input, and we have had other talks like this that have been very well received. And obviously, we would welcome interaction from all of you guys that are attending. And with that, over to Wikus.
Good morning, everyone. Hearty welcome. We're all getting used to the virtual world. So all old people like myself are also now being forced to become technologically literate, slowly but surely. So we are becoming experts at Teams and Zoom and Skype and all kinds of other hangouts, any kind of communication. A couple of technical issues before we start. The first thing is we are recording this, and the recording may end up on YouTube. So if your face is on the you may actually become a star. So just be aware that if you don't want to actually end up on YouTube, you need to just turn your camera off. The second thing is we're going to talk about a lot of things, but you have to always remember that the action that any individual takes really has to be coordinated with their personal affairs. So what we always say to our clients is what you do personally is much more important than what goes on out there. So none of what we say today should be construed as advice, meaning we don't actually want you to do anything because of what we say today. If we want you to do anything, we'll give you a written proposal or a record of advice, and that would be construed as, legally speaking, advice. But it's really because of, so there's a legal issue to that, but there's also the whole issue of be careful, what is poison to one is medicine to another. So we really need to understand your personal situation before we can give you actual advice. So with that, let's dig into what's happening around us out there where we're not allowed to go. There's obviously lots and lots of jokes and comments circulating on social media. The one guy said, well, I now understand why dogs run out of the gate when you leave it open. So just the fact that you're not allowed to go out of the gate is already something that makes you want to get out into the open and actually do a couple of things. But as they say, our fathers and grandfathers were called to war. We were called to the couch. We can do this. So I guess isolating is not the worst of things that could have happened. But I'd like to kick off with a couple of technical issues on the coronavirus, because when we first heard of it, it was kind of presented as a bad flu, a little bit like the swine flu a couple of years ago, so kind of a slightly more serious version of the flu. But it unfortunately turns out that it's not that. And one of the things that I would like to start off with is just to have a quick look at the mortality. So there's still a lot of doubt about what the actual mortality for coronavirus is, because you've got to measure whenever you want to measure a subset, you have to measure the overall accurately. And we certainly don't have any accurate measures of the total number of people being infected with the coronavirus. So we don't really know how many of those people actually died. But in terms of people who are who have been tested positive and then died, we do have some stats. Can we get our graph on these for coronavirus mortality. So they've measured mortality in different countries. The one that is most, may I just ask whether everybody's seeing a graph with dots?
Yes, I'm seeing it.
Yes,
Yeah.
I can see.
Yeah,
that
thank
gets
you.
larger to the right. So there's a very worrying thing there. If you look at the black dots at the bottom, what you will see is that if you are 50 to 59, there's about a 1% mortality. So of all the people who contracted, about 1% die. So that's about 10 times more than die of the ordinary flu. So every year, about 0.1% of people die of ordinary flu. So if you're between 50 and 59, there's a 1% chance that you'll die if you contract this virus. On the other hand, if you're 60 to 69, there's already a 3.5% chance that you'll die of the virus. So given that I'm turning 60 in August, I really need this thing to get past before August. But what's even more worrying is that if you're older than 80 in Italy, your chances if you contracted the virus was 20% to die. So 1 in 5 people who get infected, who are over 80, will die of this, most likely. In China, that number is slightly lower, and in South Korea, significantly lower again. So one of the issues in terms of deaths is that it seems like if you have a system where the health facilities gets overwhelmed, you have a much higher death rate than in places where the health facilities are plentiful, if you like. So South Korea having roughly half the mortality that Italy would have. Part of the reason why the South Korean mortality looks a lot lower is that they've tested many, many more people in South Korea than in Italy. So the testing was better, so that also gives you a better indication. But this kind of mortality is high enough that no government can stand by and see these kind of levels of mortality and not do something about it. So initially there was the thought that there's a choice for countries. Some countries would choose not to lock down and not to act strictly against the virus, but allow the virus to spread through the population. Some more people will die, but you'll have far less economic disruption, and that you would get something called herd immunity, meaning a general immunity in the population fairly quickly. So that was the initial idea. What we found worldwide is that that's not true. When people start dying, all governments in all countries eventually choose to lock down. Okay, so move on from the graph, please. Thank you.
Back to you.
Back to me, please. So what we're seeing is that the one thing that we now know work to contain the virus is to say we will go into some form of lockdown, social distancing, if you like. But effectively, I actually like the idea of shelter in place better than the idea of a lockdown, because it kind of focuses on you sheltering from the virus rather than being forced to lock down. But in essence, if you force people to stay at home, the virus pandemic will slow significantly. Now, so the first thing about the virus is the mortality is high enough that no government can resist locking down if they see so many people die. The second thing about the virus is that it spreads extremely easily. So it seems to be very easy to pick the virus up because it's airborne. It's an airways infection, so that you pick it up from the air and from surfaces. So it spreads very easily. One of the things that we see worldwide is a lot of medical personnel get ill. And that just actually goes to the idea that in spite of all the protective clothing they're wearing, in spite of all the care people are taking not to get infected, if you're dealing one-on-one with infected people, it's very, very easy for you to get infected. So the virus infects people extremely easily. And the last thing is that the virus actually is, you already have the virus before it presents in terms of symptoms. So there's quite a few days before you present with symptoms where you are already contagious. So that obviously makes it a lot more difficult to actually get the virus under control, because you don't know who has it, and people will be going around and infecting other people. It's also true that some people may be asymptomatic, meaning in many people, no symptoms may present. So people will get it, they will be infectious, but they don't present with symptoms. So that's actually very dangerous, because you just don't know that this person is infectious and that you are that you're running a risk when you're dealing with this person. So very easy to spread. So if you just allow normal behavior in humans, you get massive spread of the disease. So most people, or in most countries, actually virtually all countries, you eventually go into something called a lockdown. And the interesting thing is that the sooner you lock down, the fewer illnesses and the fewer deaths you get, before you actually get into a post lockdown situation, or a situation where the virus is no longer spreading in your country in a very dangerous way, if you like. Now, if we just look at the graphs of how this thing spreads in different countries, let's just go to the next graph. One of the things that you will find is that people talk about flattening the curve. So the idea initially was that if you allow this to spread through the community, you'll get herd immunity, but because of the fact that you exceed the healthcare capacity, a lot more people than necessary will die, and you'll put massive pressure on your healthcare workers. So the idea was that what you needed to do is to just actually flatten the curve to make sure that people did get it eventually, but they don't all present at the hospital at the same time. So you have a flatter curve. So the red curve and the blue curve, you see there was the idea behind the story about flattening the curve. The problem with flattening the curve, if we can go to the next graph, is that the actual curve looks like this. That red line right there at the bottom is what the actual capacity is of the system to handle serious cases of coronavirus. And therefore, what you see is that you very, very quickly, no matter how flat your curve is, you very quickly exceed the capacity of the medical fraternity to handle this. So it's not a question of really just flattening the curve. It's a question of bringing the virus under control. And the one thing we do know by now is that if you lock down your economy, if you tell people to stay at home unless they are doing something essential outside of their homes, that brings the outbreak under control. So we've seen it in Italy, we've seen it in South Korea, we've seen it in China, etc. In all the places where you actually have the virus, you lock down and you eventually get it under control. You can just move on to the next graph of where we see what's happening in terms of the lockdown impact. So what we're looking at is that people are now projecting what lockdowns will look like, because we know that lockdowns work. And what you see here comes from our own health department. That's the projection in India, that if they maintain their lockdown to the end of April, that will mean that infections will stay very low through the course of April, but eventually by the middle of May, you'll actually have a lot more infections. Can you just go to the next graph, please? This is now the scenario planning for the South African government. So what they're saying is we've had lockdown. We've seen the curve flatten in South Africa. The unlikely scenario is that infections will now stop. But the much more likely scenario is if we stop the lockdown, the exponential growth of the curve will still will just come back. So one of the things that we find is that although we know lockdown works, it takes a while to work in the first place. But in the second place, once you've had in the lockdown, you can't really come out of the lockdown without having the exponential infection curve coming back. Because what happens is that the initial outbreak is so small that it doesn't really give you any kind of immunity in the general population. So as soon as you lift the lockdown, you actually go back to large infections. Can we go to the next slide, please? So you should now be seeing a yellow line that represents the UK infections and a blue line that represents South African infections. So what's very interesting in this graph is that it looks like, from the stats we have available, the South African lockdown has been very successful at curbing the expansion. So interestingly enough, the two countries that we would normally look to from a South African perspective as examples of how to deal with certain issues have both been slow in providing lockdowns. Now, that, I guess, partly goes to the Anglo-Saxon tradition of a lot of freedom. Very hard for Anglo-Saxon countries to come to the decision to ask everybody to stay at home and to curb people's personal freedoms in the way that you need to do to bring this virus under control. So initially, when people saw what was happening in China, the reaction was that, very unlikely that in South Africa we'll ever be able to have a lockdown like that. And what we've seen is, yes, both in South Africa and in Britain and in America, we now have these serious lockdowns, because if you don't lock down, your curve looks a lot like the yellow curve there of the British situation. In South Africa, our president decided at a very early stage to lock down. So the number of infections has come down significantly in South Africa because of the lockdown. So the basic idea is saying we've got a very contagious virus. It has quite a high mortality rate. We know that lockdown works to contain it. Countries will all lock down once they see this kind of exponential infection curve running away in their country, but actually better to lock down before it runs away in your country. The problem that you then have is that once you're on the other side of the curve, once you bring it under control, maybe if we just move on one slide. No, actually there should be a slide where we've got the multiple countries on it. I think it's the second slide, actually. That's the one. What you will see on that slide is that some countries have successfully, it's not all that clear, the slide that you're seeing now with the multiple countries on it. But what you will see is that some countries have been much more successful at containing this than others. But the problem is that if you now, let's just take two examples. One example is Singapore. In Singapore, they locked down very early, so they never had a real epidemic in Singapore. But now they are struggling to retain that situation. So basically, they're finding that they can't unlock the economy and keep the virus out. The moment that you completely unlock the economy, the virus comes back. So you have to stay in some form of lockdown, and we're not quite sure how strict that lockdown needs to be. But I think enough about the virus and the lockdown situation. What I'm really focused on is to say, what is the effect of this on the economy? And the answer to that is the effect is absolutely severe. Can we go to the unemployment slide, please? So what you will see, just as an illustration of how serious this is, you will see that in the US, just go to the next slide. There we go. So what you see in the US is that they have a very good statistic that's quite accurate, where they record weekly claims, weekly new claims for unemployment insurance. Meaning we know these are people who have lost their jobs, they're officially applying for unemployment insurance. And we have quite good stats on that going a long way back. So what you will see is that the highest it ever goes is around 500,000 people in a single week that loses their job, and that's typically at the height of the recession. So in this case, what you see is that the recession was far behind us. We've had 10 years of upswing, so you see that those unemployment claims falling gradually over the last 10 years. And then suddenly, in a 3-week period, you see the whole stat rocketing. You can't see all the stats very clearly on the graph. What you can see is the last reading on this is 6.6 million people in 1 week that lost their jobs. Now, this is literally an off-the-charts event. If you had to draw this graph on a chart, you would never put 7 million on your left-hand axis, because you never ever think that in your wildest dreams that you'll get to that level. So what we've seen is actually in the first week of serious coronavirus lockdown in the States, they lost 3 million jobs, so 3 million new claims for unemployment insurance. Then the next week, 6.6 million, and the week after, another 6.6 million. So basically, we've seen 15 million people become unemployed in 3 weeks' time, out of a workforce of about 165 million people. Now, this doesn't count all the people who are self-employed, all of those people who work as consultants or whatever. These just talk about people with formal jobs who can apply for unemployment insurance. So basically, the economy is coming to a screeching halt all over the world. So every country that locks down, and as we say, every country eventually locks down, you get this massive increase in unemployment. And that just gives you an idea of the massive impact that the lockdown has. So our estimate at this point is that when you have the serious form of the lockdown, let's say the lockdown that we currently still have in Italy, you probably lose in the order of 30% of GDP. So GDP for the period that you're in lockdown becomes 30% lower. So that is a massive, massive, massive impact. As a matter of referral, when the recession of 2008, 2009, the credit crunch hit, the economy in the US contracted by about 3%. So suddenly, if you're now in a situation where the economy is contracting by 30%, it's completely a new event. So it's a very, very, very radical economic situation. And from a medical perspective, I always say that this would be like putting your patient into an induced coma. So there's no economic growth, but it's designed not to grow economically. You're putting the patient in bed, and you're telling the patient to stay very quiet in bed. In fact, you're inducing a coma. So we can move on from the unemployment. I think we can just go back to face, if you don't mind. Thank you. So what we've got is a situation which is extremely radical from an economic point of view. And the first thing to understand about this is that in the short run, you're now bringing economic activity to a halt. And really all that you're allowing to continue is the stuff that feeds people or keeps them healthy. So chemists are open, grocery stores are open, doctors are open, and that's about it. Everybody else stays at home and does nothing. And in fact, probably about 50% of people become unemployed or inactive. The rest of the people, those who can work from home, will start to work from home. So in our business, there's nothing that prevents us from working from home. So we actually extremely busy as it goes, and there's quite a few things that can be done from home. So that continues. But a large part of what would normally happen in the economy just comes to a grinding halt. So if you are an airport, there are less than 5% of the normal number of flights. So all airports around the world are in the process of going up very quickly, because actually you still have expenses, but you don't have any income. Your income has completely dissipated. If you're a restaurant, you're forced to be closed. So you still have expenses, you have to pay the rent. You may or may not have fired your waiters and your cooks and your chefs and whatever, but you've got no income. So your situation is going backward extremely quick. If you're an airline, I see this morning's news says that SAA's application for business rescue has now been refused by the government, meaning the government has refused to fund the business rescue. So if I understand the law, the next step is actually liquidation. So SAA may very well be liquidated in South Africa, but around the world, if you're an airline, you are going to go bankrupt unless your government bails you out. So some airlines are government owned and some airports are government owned, so the shareholders may bail them out. But if you're in the private sector, either the government bails you out or you go bankrupt. So it's actually an extremely serious situation. And what we see from an investment point of view then is that this extremely serious economic situation will eventually seep into markets. And the way it will do so is that obviously the value of a business that is now closed for the foreseeable future must be dissipating on a daily basis. So the thing that will happen in this lockdown period is that we will see a great deterioration of balance sheets, meaning those people who can't work will use the cash they have on hand to sustain themselves. So they will pay their rent and they will buy food from cash that they've got on hand. If they've got some borrowing facilities, they might use up that borrowing facilities. But by the end of the lockdown, they'll end up with a far worse balance sheet. They'll have many more liabilities and far fewer assets than they had to start off with. The same will apply to businesses. So probably about 30% of businesses will fail unless governments bail them out. In China, in the first quarter of this year, we know that 460,000 businesses actually failed just because of the lockdown. So there are some businesses which are not affected, and you'll even find some businesses that are positively affected. So we know that Zoom is suddenly a much more popular product, and therefore the Zoom share price has rocketed. So there are a couple of those examples. There's also the examples of the providers of some medicines where you see that the share prices have gone up. But on the whole, when the economy grinds to a halt, profit goes out of the window. So we believe that if you see a contraction of 30% in overall GDP, then it's likely that net profit in the economy has completely disappeared, meaning those companies making losses have larger losses than those companies making profits have profits. So there's no net profit in the economy at a minus 30% situation, which is where we are in South Africa currently, which is pretty much where we are in the US, in Britain, in Germany, in France, in Italy, and so on. So an absolutely disastrous situation from an economic point of view. And the bigger problem even than the lockdown is the fact that you can't properly get out of the lockdown. So the conclusion that we've come to is that if you're on the other side of a lockdown, if you see that you're having an epidemic, you lock down to bring it under control. It takes you about 3 months of lockdown to get your epidemic under control. If you lock down before the epidemic, it takes you about a month of lockdown to bring the new infections to quite a low rate. So you lock down for somewhere between a month and 3 months, depending on how quickly you started. And you lock down very, very seriously, losing about 30% of your GDP. But then when you come out of it, you're still in a situation where if you now allow the economy to just open and everything to go back to normal, you just get a renewed round of infection. So it's not really as if you can open up your economy at the end of the lockdown. If the epidemic had been bad enough to infect roughly 60% of people, you would have had something called herd immunity, meaning that there's so many people who are resistant to the virus that it can't really spread easily through the community anymore. And it just comes back in spurts. It doesn't really lead to an epidemic anymore. The problem is that even in the countries where we've now had very serious infections, it's likely that the infection rates are quite low. Certainly looks like less than 5% of the population will have been infected, even in a place like New York, where we've had a serious epidemic. So you can't open up the economy at the back end. So we believe that you can relax your lockdown significantly, and maybe enough to get the economy back to 90% of what was being produced before. So you go from a 70% level to a 90% level. A 90% level is still unprecedented. We've never seen in our lifetime. Well, actually, probably since the 1918 flu, we've never ever seen economies operating for a long time at 10% less than what they would normally be. And again, that means that what you're doing in the process is you're devastating the balance sheets of consumers, you're devastating the balance sheets of businesses, and you're also devastating the balance sheets of governments. So again, if we go back to the medical analogy, once you've induced the coma, the first thing that you've got to do is you've got to start feeding some glucose through an intravenous drip, otherwise your patient will die. So what happens if you send everybody home and they have no income anymore? You've got to start giving them some money or some food or some aid. So I was watching the news this morning, and I saw two very worrying instances. The one was a ShopRite being looted by people, well, essentially hungry people, I would assume. So these are people that have been sent home without money or food. After a week or two of being at home, eating all the food that there was, using all the money that there was, you'll come out of your shack and you will see that what you can do to get food, otherwise you'll die of hunger. And what typically happens is that you'll steal something, but if you see 500 other people appearing from their shacks, you'll say, let's go and raid the local ShopRite. So that's what we've seen. We've also seen riots where food parcels were supposed to be distributed. Rumors will spread about food parcels from government organizations. This morning, it turns out it was just the volunteers themselves who had made up some food packages for the specific people they were dealing with. And then when people pitched up and there wasn't enough for everybody, we had a riot. So that's what you can expect if you just send people home without money. So what you do if you are a developed country like the US or the UK is you start pumping money into the system in order to just enable people to stay alive and to buy food and sustain themselves. So this is not stimulus. So people sometimes talk about the $2 trillion stimulus package they've had in the US. It's really not a stimulus. It's just disaster relief. So what happens with governments is that their balance sheets go backward very quickly, because actually when the economy comes to a standstill, tax stops coming in. So tax revenue falls precipitously at the same time that you have many more demands on the government. So you've got to actually provide healthcare, you've got to provide policing at a much higher level, and you've got to provide aid to normal people. So in the US, what they did as part of the $2 trillion disaster relief package is they're actually sending a check to every single American adult of $1,200. So say we're in lockdown, it's a crisis, here's some money to help you. I see that the US Treasury has now managed to get Donald Trump's signature at the bottom of each of those checks to make sure that people think this check comes directly from Donald Trump. But nevertheless, this is something that couldn't happen in South Africa. Firstly, in South Africa, if you posted a check to every single individual, they wouldn't receive it because the post office is not actually functioning. So that's the first problem that you'll have. The second problem is no one will know what to do with these checks because nobody works with checks anymore. And the third problem is the South African government can't afford to pay that kind of money to every single person in South Africa. So it becomes very difficult to maintain the government's balance sheet in these circumstances. So now we're between a rock and a hard place. We're in the situation where, given the effect of the virus, we know that we've got a lockdown initially, and then we've got to stay in some form of lockdown for quite a long time. Why? Because the only thing that actually allows us to come out is one of two things. It's either herd immunity, meaning the virus spreads through the community, 60 or 70% of people get infected, and you get general immunity in the population. A lot of people die, but you get general immunity. That's the one way it happens. And it may well be that that's the way it will work in developing countries, meaning places like South Africa, India, Brazil, Indonesia, and so on. So that's the one way it happens. In my view, still the most likely thing to happen in South Africa eventually. The second way it happens is you get a vaccine. The CEO of Johnson & Johnson was on TV a while ago, and they said they are starting human trials on a promising vaccine. If that vaccine works out to be an effective, safe vaccine, they will be able to distribute this to the general population roughly by January next year. And they will be able to manufacture billions of doses, which is what you need to vaccinate people worldwide against the virus and really get the world economy back going, roughly in the middle of next year. So what this says is that the whole world will probably stay in some form of lockdown until roughly the end of this year, and we will gradually see the lifting of that lockdown in the course of next year. So really a disastrous situation from an economic point of view. And the question now becomes, what happens to markets? And one of the things we've seen a very strange reaction in stock markets to this whole phenomenon, because stock markets are supposed to price in the future very quick. But what we see is that these kind of the severe recessions that we've seen in the economy in the past have virtually all started in the financial markets. So you have an event in the financial or the credit markets that then spills over into the real economy, and that unemployment is really a lagging indicator, meaning the economy is already starting to grow again while unemployment is still increasing. So unemployment initially grows very slowly. In this case, we've seen unemployment absolutely rocket right up front. So what we're seeing is an event that did not originate in the financial markets. The financial markets were sound, the banking system was working well, the credit system was working well worldwide, and we then have this event in the real economy, and as my one client describes it, a meltdown in the real economy. So how does the stock market react to a meltdown in the real economy? And the interesting thing is the initial reaction in debt markets, meaning the market for government bonds, etc., was that safe assets appreciated significantly, because it was clear that the authorities would react to this by slashing interest rates and by buying government bonds to try to support financial markets, and that presumption was correct. So there was some profit to be made in safe assets like US government bonds and gold and so on initially, whereas the stock market actually took a long time to react. Once the stock market realized that there's a real problem and that places like the US would actually shut down for a significant period of time, the stock markets came down actually very rapidly for about 30 to 35%. So from top to bottom, stock markets came down 30 to 35%. And if you just compare that to previous events, in 2001, when the dot-com bubble burst and we had the 9/11 event, stock markets came down about 50%. In 2008, when we had the credit crunch, stock markets came down about 60%. In this case, stock markets came down 30%. And then on the news of stimulus packages from the Federal Reserve, plus the American government, plus the news that the virus infection seems to be peaking in New York, stock markets actually went back up. So stock markets, as we speak, are down about 20% from their previous high. Now, our assessment of this is that is just way too little. So from our point of view, we say we think that stock market should come down about 60% to accurately reflect the trouble in the economy. In fact, at least 60%. So we think that the 20% that stock markets are down is way too little. We think that stock markets are likely to actually come down significantly more. So we think actually from current levels, if we're now at roughly 80% of where we started, we think we should end up 40% of where we started. So we think that stock markets over the next year will probably about halve. And one of the main reasons for that is that we think that even once the virus is behind us, so let's say that in the course of next year, the economy returns to normal from a health point of view. The problem that you have is you then have the classical definition of a recession, meaning you have consumers with very low confidence. So one of the things that we're hearing from China, where people are now returning to work and where the economy is starting to open up, people don't have the confidence to actually go out and visit restaurants and etc. etc. So people's confidence are very low, and what that will mean is that people will want to produce as much as they can. They'll be very eager to get back to work, but they will be very eager to save as much of that money as they can, meaning they will want to fix their balance sheets. They'll want to repay the debt they made to sustain themselves during the lockdown. They will want to rebuild their cash reserves. In fact, they will want to build much larger cash reserves than they had in the past, because they now have a very different conception of what a disaster looks like and how much money you need to deal with that disaster. The same will go for businesses. Businesses will come out of this and they will not have the confidence to invest, meaning they will want to sell as much as they can at as high margins as they can, but they will then want to rebuild their balance sheets. They'll want to pay down debt and build up cash reserves. So any investment project is more than likely to be postponed. And in some ways, the same will be true of governments. Will come out of this with much higher debt levels than they have now, and they will really have no assets to show for all the money they spent on disaster relief. So they will actually also want to be very frugal. But governments are not like businesses and individuals. They have the ability to print money, they have the ability to borrow money, and they have the ability to try and stimulate their economies. So these economies, because of the lack of confidence in consumers and businesses, which will devastate spending, these economies will need a lot of stimulus. So this is a little bit like your patient who's now been in an induced coma for 6 months. When he gets up, he won't actually be able to walk very nicely, and certainly not able to run, because his muscles will have dissipated while he was in the coma. So what you do is you give it a big shot of steroids. So governments will want to stimulate their economies, but they will want to actually also build up the asset side of their balance sheets. So what they will most likely do is they will all be in a rush to have massive infrastructure projects. So infrastructure projects in around the world will be in great demand. Now, the interesting thing from a South African perspective is that infrastructure is something that eats commodities. So when China was building its infrastructure in the 2000s, we had what was called the super cycle in commodities. China imported massive amounts of steel, copper, etc., in order to build up their infrastructure. So these things are likely to happen around the world. So massive demand for commodities. So actually good news for South Africa on the other end of this. But this will start to flow into economies in kind of 2022, between 2022 and 2025. So something that's a lot later. From our point of view, we think that this is a very serious recession. We think that the unusual situation of the meltdown in the real economy, markets are just not geared to digest that very easily. But as results of companies start flowing in over the next 6 to 9 months, the stock market is likely to go a lot lower. We think the one place where the trouble in the economy has been quite accurately reflected is in the oil price. So what we see is that there's been a reduction of between 20 and 25% in oil consumption worldwide. So oil normally is about 100 million barrels per day gets pumped. So 20 to 25% means that we're seeing about 25 million barrels per day less demand for oil. And that has pushed the oil price right down. So the oil price was down about 60% from the top. But we now seem to have a deal between oil producing countries to cut about 10 million barrels per day, not quite enough to really bring it under control. And one of the problems we see in the oil market is there's no place to store the oil anymore. All this oil storage has been taken up. So likely that oil prices will have to go right back down eventually, unless there's a massive additional cuts in production. But that just gives you a realistic take on how bad this recession is. So what is the investment results of all of this? So the first thing is that if you have been a client of Classic Wealth, you're absolutely fine. First of all, because you did proper financial planning, you've got more than enough cash because you've made sure that you have enough cash to sustain yourself for the next 6 years. So that has been in place. Plus, the bulk of your investments has been outside South Africa, where the currency has depreciated precipitously. So one of the effects in markets that we've seen of falling stock markets is that generates a lack of dollars. And globally, that has led to massive depreciation in the currencies of especially emerging markets, but also of some developed economies. So we've seen the pound go to its lowest level since 1985, for instance. So there's a lack of dollars and liquidity squeeze around the world. That's the main reason for the weaker rand. But most of our clients' long-term money has been sitting offshore, so they're benefiting from that in some ways. But the other thing is that they've been in a very diversified portfolio, which was not equity-centric. So whereas the rest of the world was down 35%, our clients were down about 7% in their dollar portfolio. So actually, our clients are sailing through this situation. So all the normal homework of saying we are prepared for any unusual or unexpected event, this event unprecedented and completely unexpected, as Bill Gates said, not unexpected that there's a pandemic, but it wasn't expected right now. You never know exactly when it will strike. An unexpected event, because you were preparing for an unexpected event, you can now sail through this event quite nicely. But what do we do going forward for our clients? The first thing is we believe that this will be actually a fantastic opportunity to acquire equity at much lower prices, but we're going to have to be patient. So markets are not pricing this in. The stimulus that the authorities in the US are putting into the economy has been enough to staunch the bleeding in financial markets. But we believe that eventually the markets have to go down a lot more. Exactly how much is not clear because we're not quite sure of the effects yet. But we do know that it's much more severe than the stock markets are pricing in now. So we believe that the bottom of the stock market, we think that we'll see a classic bear market, meaning we'll see drawdowns in the market followed by returns or upswings. But the upswings will every time be smaller than the downdrafts. So you eventually get a gradual reduction in the value of shares. And we think the right place is about 60% down. So we'll put our clients back into the market when the markets are down about 60% from the top, which means probably at about half the current levels. And we think that we'll gradually see that filtering into markets. The other thing that may happen is that the markets may not go down quite as much, but we will get to a point where markets realize exactly how dire the situation is in the real economy. And once the real economy is recognized by the markets and the authorities, and we get to a point where enough stimulus has been announced to actually turn the economy around, that would be a good time to re-enter the markets, even if we're not down quite 60% at that point. But we do think that that is then followed eventually by a multi-year bull market. So if you think about the credit crunch, stock markets came down 60%, and then it took markets about 5 years, so from 2009 to 2014, to return to where they were before the credit crunch started. So what you have is a 5-year bull market that takes you up about 150%. So we think that's about right for this cycle as well. We think that markets will go down about 60% eventually. And if you re-enter the markets at that point, they won't actually return overnight to where they had been before. So the so-called V-shaped recovery, we don't think there's any likelihood of that, much more U or W-shaped. So we think there'll be ups and downs in it. And we think that that you eventually have a gradual multi-year bull market that will take you up quite a lot. So we think that our clients there will be a very nice opportunity for our clients to participate in that. What we're saying to clients who are potential clients that we're meeting up with now is we think that you should, at these prices, you should gather as much cash as you can. You should get out of the stock market because the stock market is an extremely risky place at this point, with very little upside and massive potential downside. So we think turning as much money as possible into cash and then getting ready to get back in when we see the bottom. So that's roughly what we would say. The other thing, of course, is, first of all, apply good planning principles. Make sure that you have enough cash to sustain yourself over the next 6 years while you wait for markets to return to good value. The last thing that I'd like to touch on is the whole question of the rand and the currency, because we've seen the currency go to unexpected lows. So that what we've got is we've got the coronavirus crisis on top of a downgrade in the country's credit rating. So both of these two things together have pushed the rand to unprecedentedly low levels. Now, the thing to ask about currencies, first of all, currencies are always a relative thing. So the question is South Africa in a worse position relative to where they were before? So South Africa wasn't in a very strong position when we went into this crisis, but has our relative position become a lot worse during this crisis? And the answer is no, because everybody else is as badly affected as we are. So it may be true that emerging countries will be worse affected. We'll see, because they don't have the same capacity to deal with these health issues that developed economies have. So it might be correct that there's a little bit of a repricing of developing countries happening. So it's not a uniquely South African thing. But that still says that the rand should be at, let's say, 15 rand to the dollar and not 19 rand to the dollar. So that's the one part of it. The other part of it is to say, what happens eventually? Do South African exports get negatively affected by this whole event? And the answer in my mind is no. Yes, in the short run, economic growth is what drives the demand for commodities. So demand for commodities, which, as we can see in the oil markets, demand for commodities will be low for a while. But eventually, demand for the kind of commodities that we export will be quite high. So we are likely to see actually quite strong demand for our exports in the period 2022 to 2027. So really no reason in these events to think that the rand should be weaker. Maybe just one last comment on South Africa and the situation we have here. In South Africa, we had quite a precarious situation to start with. So we've got actually a very competent president. The president has been widely praised for how quickly and how rationally he has reacted to this crisis, certainly much better than some other countries we could mention where people like Boris Johnson and Donald Trump are in charge. But that president wasn't fully in charge of the country. The president has massive political problems inside his own party, so he's clearly not fully in control, and that's already a problem. The second thing is that if you try to maintain a serious lockdown in a country like South Africa, where you are struggling to put money and resources into the hands of the vulnerable while this lockdown is happening, you could get some serious political issues. So if people are hungry and they come out and they start raiding grocery stores, and the government then sends in the troops and the police, and we know that the level of discretion at the ground level is not very high. That's why we hear about very hard treatment that people are getting at the hands of the army from time to time. That's really a recipe for disaster. And the really worrying thing is that if we don't handle this correctly in South Africa, we end up with an alliance between Ace Magashule and Julius Malema in government after the next election, rather than to see Cyril Ramaphosa re-elected. So in some ways, he's gained a lot of ground, Ramaphosa, but in other ways, this presents an extremely difficult situation. And if we get to the situation where lockdown turns into repression, I think that's a serious political risk for South Africa. And you basically have two choices. The one is that you can open up the economy more quickly, which just risks the virus spreading much more quickly. Again, the early indications are we're not containing the virus in any case. So even though we've slowed it down, it will eventually spread into the whole economy. So we'll have a serious epidemic peaking in roughly August. And then by September, October, we're out on the other side with general immunity in the community. That's the most likely scenario for the virus in South Africa. If that happens, then you can unlock the economy and you can get people going again. But there's a lot of things to happen between now and August. And if you don't put a lot more effort into supporting the vulnerable in this situation, you are likely to see some fairly serious political consequences in South Africa. So our own view of the world is still that so even though we believe that the rand should be significantly stronger eventually, we still believe that if you want to preserve your long-term wealth, you should go into a diversified global portfolio rather than to dabble in South African shares. Questions and comments?
Wikus, I'm going first. It's Lee here. Thanks very much for that. Just my first question, as you know, our clients and potential clients, one of the questions they ask first is whether it's the time to send money offshore now. In other words, do we buy our dollars now or not?
The answer is really that I wouldn't want to turn rands into dollars at weaker than 16 rand to the dollar roughly. So even 16 rand to the dollar is 16 rand to the dollar is one standard deviation to the weaker side. So the long run average for the rand is about 14 rand to the dollar, and the currencies have a strong return to mean tendency. So we believe it eventually does go back to 14 rand to the dollar. So now it's not a very good time to do that. So actually rands is not a bad place to be. What we normally do for our clients, though, is to say one of the things we've learned from this is you want to be able to move quickly when market opportunities present themselves. So what we actually do is we do take our clients' money offshore, but we hedge back into rands to make sure that we actually unhedge at a time that the rand is a lot stronger. So right now the rand is really too weak. We don't think that it will turn out to be a sound decision in the long run to turn rands into dollars now.
Thanks, Wikus. And are there any other questions arising from that?
Yes, Wikus, come on. Quick question. So for a client or for a potential new client who wants to participate or prepare him or herself to participate in the upswing if and when it comes, do you think dynamic parity is a good place to be in to participate?
Yes, it does. I do think so. I think that what happens in dynamic parity, if you think dynamic parity, by the way, is a fund run by Ironclad, which is a preferred supplier of ours, and it's a multi-asset fund. So what they do in dynamic parity is they have triggers, which tells them when to invest. So at this point, they're pretty much in cash. But as the right circumstances come along, they will start to participate in various assets at different points in time, meaning there's likely to be an earlier opportunity in, for instance, government bonds than there is in equities. So dynamic parity is a fantastic place to be because as opportunities present themselves through the crisis, you will participate through dynamic parity. But the main thing to know is that dynamic parity is something that it's very resistant to surprises because of the multi-asset nature of it. There's always something in dynamic parity that performs. So even in a circumstance like we have now where things are very uncertain, that's the kind of fund where you really want to be. We've had long conversations with the managers at dynamic parity. For the moment, their view is risk is much more than opportunity, so they're being extremely cautious. But there comes a time towards the end of this crisis where they will say, we want to make sure that we participate in the upside. And we will actually let our clients know at that point that, you know what, volatility may increase because participation will go up. But we think that in this whole situation, the first thing to get right is to not get caught in the downdraft. The second thing to get right is to make sure that you participate on the upside. And the managers at Dynamic Parity are very aware of that, and we're confident that the fund will participate in the upside in the way that it did in the previous upswing. So essentially, in dynamic parity, what's happened is that they've kept up with stock markets in the good times, and they've not participated in the bad times. So it's turning out to be really something very satisfactory from our clients' point of view.
Thanks, Wikus.
Wikus, Greg Barnes here. I just want to ask you what your view is on gold.
Gold is an interesting thing in the sense that, you know, the old story about what is gold actually for, you dig it up in one place and you store it underground in another place. But the interesting thing, the best way to view gold is as a currency that doesn't have a yield. So when other currencies also don't have a yield, it's actually very positive for gold. So what you find is that, interestingly enough, in the initial stages of this crisis, the gold price actually went up quite a bit, which it normally does in the middle of the crisis. And then it came back down as the liquidity crunch set in. So the same liquidity crunch that pushed the currencies lower also pushed the gold price lower. But that's likely to dissipate. It's very likely that in hard currencies for multiple years, probably 5 years from now, interest rates will be zero or very close to zero. So you won't have a yield in yen, you won't have a yield in dollars, you won't have a yield in pounds, and you won't have a yield in gold. But gold you can't print more of, whereas everybody will be trying to print more dollars, more pounds, more yen to try to stimulate their economies, and you can't print more gold. So I think that the circumstances is actually propitious for gold. We think that you should have about 10% of your portfolio in gold.
Thank you.
Are there any other questions? If not, let me remind you, and welcome to Brendan, who managed to get in a bit later. We are recording this talk, and we'll send you a copy as soon as we've had it sorted out. But thanks again to Wikus, and a reminder as well that Wikus is conducting these talks every week. So people like you who have been able to attend today can clock in next week on the same day, Wednesday, to the second half of his talk. So his first half is going to be for people who haven't heard this talk before, and the second half will be just an update for those people who have. So we'll send you the invitations, and hopefully we'll be able to make contact with you guys again next week. Thanks again, Wikus.
Thank you.
Thanks, guys. Have a great day.
Yeah, thank you.
Thank you. Bye-bye.
Thanks, guys.
Thank
Bye.
you.
Thank you.
Thanks all.
Thank you. Thank you. Thanks, Lee.
Pleasure.